I'm back again with my Facebook Live, and this time, guys, I would like to show to you how to trade this KBH using an option trade. And market is about to close, so we can still demonstrate how to enter the trade using interactive broker. So I have spotted an opportunity, which is this KBH home. And looking at the chart, as you can see, it's uptrending at the weekly time frame. And looking at the daily chart, as you can see, the price is bouncing on the key support level. So in this case, I'm expecting that the price in the coming days or following weeks, the price of KBH will be trending and even can target this resistance area here. And so how do I express the trade in an option trade so that I can take advantage of this opportunity? Number one is that I can buy a call with a long expiration date, buying at a strike of 40 or 38 and holding it for more weeks. So if I will be buying a call, it means that if the price of the stock will continue to rise up, so as the call option. So in that case, you will make money. However, if the stock of KBH will just go very, very slow, sometimes it goes up and sometimes it pulls back and stays here for a very long time. And if you are buying a call option, in that case, it is quite bad for that call option, because the time decay can really affect the pricing of the call option. So instead of an increasing price, the price of an option can decline due to time decay. So, but another way to trade KBH using option is using credit spread. And instead of buying call, I will be selling a put option, which is pinned at let's say the strike price of 38. I will sell a put, and then I will buy a protection at 35. So why do I buy a protection? It's because if ever the price of the stock will go down and will further decline, I will be protected, so my losses will be capped or will be limited. So that's part of the risk management of the trade. So there is a limited amount of losses that I can take whenever the price will just quickly dive down. So without any kind of protection, the option, the sold put, can really increase in value, which is very, very bad for the position. So let me demonstrate to you how I'm going to set up my trade using interactive broker, where I sell a put at 38 at strike 38 and buy a protection, buy put at strike 35. So with this trade combination, we are expecting to get the credit from that out of the trade. So meaning that the market will pay for us, will be paying for us to open the trade. So what is the goal of that trade is that let's say 1 month expiration, we want that the price of the option or the price of the stock will stay above 38 in the duration of that option expiry. So let's say, okay, so 38, I will show to you the platform. Here it is, and I choose a 1 month expiry, which is 28 days here. That is the the lowest one that I have here. The next one is 56 days, so 28 days I will sell put at the strike at 38, and I will buy put at the strike 35. So right here is the default is sell. I will set it to buy. So as you can see, we have here a bid and ask of 0.40 and 0.15 cents, so a little bit wide spread here, so it's not really the best kind of spread. So in order for you to get better spreads when trading options, especially credit spreads, it's really more advisable to trade those big stocks like Apple, Tesla, Microsoft, Nvidia, and so on, and the ETFs as well. So but for the sake of demonstration, I'll be showing to you this one. So the best is really not to hit the market order, but really to put, let's say, the middle or slightly close to the highest bid, or this the bid close to the bid price. So let's say I put it to 35 cents. So this trade means that if you open this trade and it gets filled, then the market will pay you $35 for that trade. So but according to my account size, I can set it to 4, so to have this margin impact of 1000. So 4 times 0.35, it's around $1.2, which is if you multiply it to 100, it will become $120 credit for this trade. So let's submit that. So and then you should never forget that you are selling 38 and buying at 35, and you should never reverse this this one if you are opening a put spread. Alright, so let's submit that one. It might not get filled now, so if it won't get filled now, so especially it's already the market is closed, then it might be filled next week. But you need to make it sure that your order here, so right now, so it's cancelled because it's closed, but we can there is another one here. We can set this to a GTC, so meaning to say that if it is a daily order, once the market will close, this order will just cancel out. But if you would like to that this order will get filled next week, then set it to GTC, and then you just click submit. So that will be good till next week. So this one has been cancelled. I have submitted it earlier. So 0.35 cents times 4, that's around actually it's 140. So let's check whether we can see some details here. Alright, so as you can see, it's $140 credit. So when will you get that 140 in full price? Again, we go back to the price chart, that our goal here is that since we expect that the next coming days or weeks the KBH stock price will rally or stay above 38. So main point here is that the price of KBH should stay above 38 in the next 28 days. And if it is so, then the $140 is clear money. And what happens if KBH price will just jump high as high as 48 in the next 5 days? So it means that instead of waiting 28 days till expiry, then it can be that within the 3 or 5 days you'll get the almost full price of the 140. It's because the 1.4 option price for the put spread will decline to, let's say, 0.2, and at 0.2 it means that you can buy it back. So you sold put at put spread at 1.4, then you can buy it back at 0.2, so $20 to return. So you got 140, and then you return $20. So overall you'll take 120 credit. What happened if the price of KBH will just go slowly and pull back? It's okay as long as the price of KBH remains 38, above 38, so that you will be fine. What about if the price of KBH goes up and then goes down and hits your your strike 38? It means that the price now of your put spread will rise, like instead of 1.4 it will become, let's say, 1.8. So at this time it's not good to close this trade, because you'll be incurring losses, and if you sold it at 1.4 and you buy it back at 1.8, so basically you'll get a loss of $40. So, but of course, if there is a reason to believe that it won't be able to bounce back anymore, then you can close it. But usually what I do is that I put a stop loss. So if I sold it at 1.4, I set a stop at times 2 of the credit. So I put 2.8 as a stop loss. So in that case, I will be losing $140. But take note that this is the probability game. So we have already, with this kind of trade setup, we have already a probability that we will be winning 2/3 from the outcome, because there are two possible outcomes that are successful when it's rising up fast, and then or it's just going sideways, pull back sideways. So you can still be profitable. It can even go to the below the 38 strike price and then bounces back. That is also a possibility that you will still make money from this market. And the only thing that you will lose money is that if it will really break below the 38 and stays there until expiry. So that is the risk. But actually, even if there is the risk of that kind of market move, you can actually move that. You can move your strike much lower if you still believe that the price can bounce back anytime soon. So instead of having it at 38, you modify your strike to 30 to 35, for example, and the protection will be lowered as well, like let's say 32. But that also entails some money, because you need to buy it back at that price, which means also you are taking a loss and then reopening a new trade. But reopening a new trade, you'll get another credit here. So let's say you'll get again another, so let's say 1.0 as a credit. So if you multiply it to 100, that will be $100. So if you took a loss here of 40 and then you get another credit of 100, then overall your net you are still positive in this trade. So that's it, guys. So next week, watch out for my next live, my FB live about this setting up an option trade in the US market.